welcome back to this week's market update. Today is Monday, July 20th, 2026, and we'll jump right in. Stocks fell last week as a renewed risk-off rotation out of technology, particularly semiconductors, weighed on the broader market. The Nasdaq Composite fell 2.9%, followed by the S&P 500, which was down 1.55%, and the Dow Jones Industrial Average holding up better, down just 0.93% last week. Now, shifting gears to the economic front, it was a very heavy week for economic data across inflation, retail sales, sentiment, so we will jump right in. Starting with June's CPI, it came in much better than expected, with headline inflation coming in at 3.5% year over year, well below the 3.8% consensus estimate, and well below the 4.2% rating in May. Alternatively, core CPI, which excludes food and energy, was up just 2.6% annually, down from May's 2.8%. Now we'll shift gears into the categories driving this lower inflation in June in the next slide. During the brief ceasefire in June between the US and Iran, we did see energy prices plummet accordingly, with the energy category overall down 5.7% in the month. Energy commodities down more than 9% in the month. These contributed a lot to the headline number being negative here, negative 0.4% in June there. Looking at other categories, groceries were up 2.7% from a year ago, a very normal pace of inflation there. New vehicles were up just 0.5% from last year, while used vehicles were actually down 1.8% from last year, reflecting continued softness in the auto market. And then last but not least, shelter was up just 0.1% in the month to a very moderate 3.3% inflation rate. Overall, even with that better than expected CPI print, we do have some challenges on the horizon. So already in the first few weeks of July, gas prices have reversed a lot of the progress that they were making last month. You can see gas prices were up about 1% on Friday, 2.5% from a week ago, and then previously down quite a bit on the month-over-month change. Now we are just about 1% lower than gas prices a month ago. Then when you look at the year-over-year change, we're still up a pretty whopping 25.9%, and obviously that's going to continue to flow through to inflation on an annual basis. So although we did have a better than expected June print for CPI there, definitely still some challenges on the horizon, with a lot of that depending on the outcome of geopolitics. Looking at expectations for July's inflationary data, currently we are expecting inflation to continue moderating from that 3.5% rate to 3.3% rate. Core CPI also expected to moderate slightly from 2.6 to 2.5%. And then core PCE, both expected to be a little bit stickier in the mid 3% range. To a lesser extent than June's CPI report, wholesale inflation showed signs of improvement last month, with headline PPI falling 0.3% month over month, core PPI up just 0.1% during the month. Now, this was mostly led lower by energy, which was down 6.4% in the month of June there. Foods prices were also down quite a bit, leading goods prices overall down 1.4% during the month. Services were up 0.2% in the month of June, with trade services and other services leading it higher, while transportation and warehousing led it lower. Last but not least, looking at the headline figures, this is where some caution comes in. So although we did get negative inflation on the month, inflation still is quite sticky at 5.5% headline, 5.1% core, and that core number actually remained month over month. This excludes food and energy prices, so it's quite a cautionary thing to be aware of, with core inflation holding up so high as it's not affected directly by energy prices. While investors welcomed the better than expected CPI report, this elevated wholesale inflation report and the recent reversal in energy price improvements in July suggest that inflationary risks are still on the horizon. Moving on through our week, we also got retail sales data for the month of June. It came in better than expected, with retail sales rising 0.2% in the month. However, when you exclude gasoline sales, this actually was up 0.7% during June. Excluding both autos and gas station sales, retail sales were up 0.4% in June. Looking at several of the categories behind that retail sales print, you can see overall we did have retail sales up 0.2%. Motor vehicles and parts had a stronger month, almost up 2% in the month. Food and beverage sales were actually down 0.2% in the month of June, so kind of an odd trend there. That's not very typical. Food and beverage sales were only up 1% from last year. Gasoline sales obviously plummeting, down 5.3% in the month, still up almost 20% from a year ago. And then last but not least, non-store retailers were up almost 2% in the month and 14.2% from a year ago. And this is largely online shopping. So it really just goes to show how fast growing online shopping is, even despite some weakness in other categories like gas station sales due to lower commodity prices and even grocery sales. Last piece of economic data we'll take a look at here before closing out. Consumer sentiment rose again in July, up 9.9% in the month, although it remained 11.8% below year ago levels. The improvement was pretty broad-based though, however, with the current economic conditions index rising more than 15% in the month and the index of forward-looking expectations rising at 6.5%. Both measures were below year-ago levels, which makes sense. The overall index is still below last year's levels by far, with the current conditions index down 19.3% from a year ago, while expectations were only down 6.4% from a year ago. Year ahead inflation expectations also improved, declining from 4.6% in June to 4.2% in July, though still elevated in terms of historical norms. The recent improvement in sentiment is encouraging, but you can see over the long term, it's still really subdued. So that concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.